That's right. So now we've got the business cycle and liquidity cycle completely dominating everything. And people don't want it to be that easy. They don't want it to be that easy. They love complexity because it makes people sound smart. Simplicity, they think is stupid. But the simplicity seems to work extremely well. You know, that whole bell curve meme, you're better to be on the left side, which is number go up. The right side of that is number go up as well. And that's because you understand all of the mechanism that's at play. Everybody in the middle of the bell curve is arguing why the market's going to crash, why everybody's going to go to war, why money printing doesn't lead to liquidity that gets into the system, why the plumbing doesn't make that happen, all of the stuff that we get. But the number go up. And, you know, I just think it's a very, very powerful force that people don't want to believe because it questions their belief system. Because most people actually, a lot of people love to see stock market crashes. It's like this weird thing. So right now, crypto as an asset class is $2.5 trillion.
Don't forget to subscribe, traders. Let's continue with the interview to analyze it later and also comment on some of the most important news of the day. In the realm of finance, market forces and investor behavior are driven primarily by business cycles and liquidity cycles. These two elements are underscored as the principal factors that shape market dynamics. This perspective challenges the conventional wisdom that successful investing necessitates complex analyses and strategies. Instead, it highlights the power of simplicity in investment strategies. Business cycles, which encompass the periods of expansion and contraction in economic activity, play a crucial role in determining market trends. During periods of expansion, increased economic activity typically leads to higher corporate profits, which, in turn, drive stock prices upward. Conversely, during periods of contraction, reduced economic activity can result in lower profits and declining stock prices. Similarly, liquidity cycles, which refer to the availability of liquid assets in the financial system, significantly influence market behavior. When liquidity is abundant, investors are more likely to take risks, pushing asset prices higher. On the other hand, when liquidity is scarce, investors tend to be more cautious, leading to lower asset prices. The focus on these cycles brings attention to the number go up theory, which suggests that the fundamental force driving markets is the general tendency for asset prices to rise over time. This theory posits that despite short-term fluctuations, the long-term trajectory of markets is upward due to economic growth and inflation. By emphasizing the dominance of business and liquidity cycles, the argument is made for the effectiveness of straightforward investment strategies. Rather than getting bogged down in overly complex analyses, investors can achieve better outcomes by recognizing and aligning with these fundamental market forces. This approach not only simplifies the investment process but also enhances the likelihood of success, proving that sometimes, less truly is more in the world of investing.
If I just use the log regression channel of Bitcoin and just project out the growth rates of crypto versus the internet, and assume it slows down massively from here, it gets to $100 trillion by about 2032. Now, $100 trillion, we throw around numbers like 100 trillion. You've got to understand, $100 trillion, we're creating $97.5 trillion of new wealth. That is the largest generation of wealth in the shortest period of time in all recorded human history. When you understand that the S&P 500 is a $50 trillion market cap, and that took 100 years of value accretion by the US economy and those companies, this is double that. We've never seen anything like it. So it's an extraordinary opportunity. Now, of that 100 trillion, will Bitcoin be 50% dominant in that market? No. Because to get to 100 trillion, we have to be using the whole blockchain infrastructure for things like the finance system, for Web 2 businesses, for all of the other elements, not just the moneyness element or the store of wealth element that Bitcoin has. So if the world were 100 trillion, what is the value of Bitcoin in that? Maybe it's 20 trillion. Maybe it's 15 trillion, whatever that number is. So It's the overall space that's going to see the growth.
Bitcoin, the pioneering cryptocurrency, continues to demonstrate its significant growth potential despite various market challenges. Recently, Bitcoin experienced a noteworthy rebound, surging by 6.4% after a series of sell-offs that were primarily driven by governmental actions. This recovery underscores the resilience and adaptability of Bitcoin traders, who have successfully navigated through the bearish sentiments that initially caused the market dip. The ability of Bitcoin to bounce back from such setbacks highlights its enduring appeal and the strong confidence that investors have in its long-term value. As a result, Bitcoin's growth potential remains robust, reflecting the continued interest and trust in this leading digital asset.
When I divide the Nasdaq by Bitcoin, Nasdaq's down 99.97%. What's the fucking point? You just own the strongest asset. If everything is correlated and driven by the same forces, you end up with a logical conclusion, which is you only need to own one asset, which is crypto, which is bizarre. And then the game is, okay, which crypto is outperforming? You do charts of anything versus Bitcoin and anything versus Ethereum, and if anything looks like it's breaking out versus those, that was Sol. So now my job is to look at anything versus Solana.
Yeah.
But Solana's a big project, so if it's a small thing, maybe WIF or one of the memes, I'll have a small position, but I won't put my life savings into it. But Solana's big enough, has big enough network adoption effects for me to say that's fine.
Bitcoin's market dynamics today are intricately linked to movements in the US stock markets. Notably, Bitcoin's recovery is largely influenced by these markets, which serve as a barometer for broader economic sentiment. In recent developments, the S&P 500 has reached a milestone, hitting a record high post-holiday. This achievement marks the 34th record of the year, underscoring the strength and resilience of the stock market. Such performance not only boosts investor confidence but also creates a favorable environment for riskier assets like Bitcoin. Furthermore, the current trend of rate cuts has significant implications for Bitcoin. Lower interest rates reduce the opportunity cost of holding assets that do not yield traditional returns, such as Bitcoin. As a result, investors are more inclined to allocate funds to Bitcoin, viewing it as a viable store of value and a hedge against inflation. Overall, the interplay between stock market performance and monetary policy is playing a crucial role in shaping Bitcoin's market behavior. The record highs in the S&P 500 and the supportive monetary environment are providing a bullish backdrop for Bitcoin, encouraging its recovery and growth.